Welcome to Personal Finance Deep Dives, where we help you make your money work for you. Today, we're going to tackle a number that pretty much dictates your entire financial life, the interest rate. It's kind of like this hidden price tag on everything, from your credit card to your house, and really understanding it is the key to mastering your money. So let's just dive right in with a question I hear all the time. How is it that you can get a mortgage for, say, 6.85%, but your credit card is hitting you with over 18%? I mean, that's a massive gap, right? And while it might feel totally random, there's actually a very clear logic behind it. It all starts with figuring out what an interest rate really is. At its core, an interest rate is, well, it's just the price of using someone else's money. It's that simple. Think of it like rent. If you borrow money, the interest is the rent you're paying for the privilege. And on the flip side, if you're saving money in a bank, the interest you earn is the rent the bank pays you for letting them use your cash. So where do these rates even come from? Well, in the U.S. economy, most of them trace back to a single source, the Federal Reserve and its most powerful tool, the federal funds rate. Now, this isn't a rate you or I ever deal with directly. It's the rate banks use to lend money to each other, literally overnight. But you got to think of it as the foundational domino. When the Fed tips this one over, it sets off a chain reaction for every other rate out there. Okay, so here's how that ripple effect actually works. First, the Fed announces its target rate. Immediately, banks change what they charge each other for those overnight loans. And then, and this is the crucial part for you and me, the banks pass those new costs right along to us, the consumers. It's why when you hear on the news the Fed raised rates, you know the cost of your next mortgage, car loan, or credit card balance is about to go up too. Now, the Fed might set the baseline, but it's not the only thing going on. The price of money also follows the most basic rule in economics: supply and demand. Think about it. When the economy is hot and everybody wants to borrow money to buy houses and cars, that high demand for credit, it pushes rates up. But if people are saving a lot and there's a ton of cash floating around to be lent out, that high supply of credit pushes rates down. And then there's the third major piece of the puzzle: inflation. Lenders aren't clueless, you know? They understand that the $100 they get paid back next year will buy less stuff than $100 does today. So to protect themselves from that loss in purchasing power, they bake a little extra into their interest rates. It's why, as a rule of thumb, when you see inflation going up, you can bet interest rates are going to follow right behind it. So when you put these three forces together, you've got the Fed's policy, you've got market pressures from supply and demand, and you've got inflation. You start to see that interest rates aren't just pulled out of thin air. They're a calculated response to what's happening in the economy. And that brings us to takeaway number one. Rates are set by a mix of Fed policy, the supply and demand for credit, and the rate of inflation. Okay, now that we know where rates come from, let's decode the different types you'll actually see. First up is the one you see plastered on every ad, the nominal rate. This is the simple, stated interest rate, the sticker price. If a loan says it's got a 5% nominal rate, you pay $5 of interest for every $100 you borrow. Easy enough. But that nominal rate doesn't really tell you the full story. To get what's really happening to your money, you've got to factor in inflation. And that gives us the real rate. So let's say your savings account pays you a 5% nominal rate, but inflation is running at 3%. While your real rate of return, the actual growth in your spending power, is only 2%. This is the number that tells you if you're actually getting ahead or just treading water. And finally, we've got the rate that reveals the often hidden but incredibly powerful cost of debt, the effective rate. This one includes the magic or the terror of compounding. That's when you start paying interest on your interest. It's a massive force, especially with credit cards, and it means the rate you're actually paying is almost always higher than the advertised nominal rate. Let's just watch how these three rates play out on a single car loan. So the dealer advertises a 6% rate. That's your nominal rate, the sticker price. Simple enough. But let's say inflation is at 2%. Your real rate, your actual gain in value, is just 4%. And then comes the big one. Because the interest is calculated monthly, the compounding pushes your effective rate, what you are truly paying, up to 6.17%. See? 3 totally different numbers, all for the same loan. This is exactly why you have to look past that big, shiny number they put on the advertisement to understand what's really going on with your money. And that brings us right to takeaway number 2. The nominal rate is the sticker price, but it's the real and effective rates that show you the true financial reality. So why does all this matter so much? I mean, what's the big deal? Let's talk about a mortgage. On a $200,000 loan, the difference between a 3% rate and a 5% rate might not sound like a lot, just 2%. But look at this. Over the life of that loan, that 2% difference means you will pay over $36,000 more in interest. It's a massive, massive impact. And if you think that's bad, the effect is even more dramatic with something like high-interest credit card debt. Get this. If you have an $8,000 balance at 18% APR and you only ever make the minimum payments, you could wind up paying over $8,200 in interest alone. That's more than the original debt. And it would take you about 9 years to finally pay it off. It's just wild. These examples just hammer home how critical it is to pay really close attention to the rates you're being charged. Over a long period, tiny little differences add up to an absolutely staggering amount of money. And that brings us to our final takeaway. Small changes in interest rates have a massive impact on the total cost of borrowing over time. All right, let's do a super quick recap of our key takeaways from this explainer. Number 1, interest rates aren't random. They're a calculated mix of Fed policy, supply and demand, and inflation. Number 2, the nominal rate you see advertised is just the sticker price. You have to look at the real and effective rates to get the true story. And number 3, never underestimate the power of a single percentage point, because tiny rate differences lead to huge differences in cost over the life of a loan. That's all for now, folks. Please like, share, and subscribe for more like this.